Welcome to the Deep Dive, the show where we cut through the noise and get straight to the insights you need to be truly well-informed.
That's us.
Today, we're diving into a topic that feels like it's everywhere you hear it in the news, people talk about it, but honestly, it often comes across as this complex, overwhelming maze.
Yeah, cryptocurrency.
Exactly.
Right.
So if you've ever felt curious, maybe a little intimidated, and definitely unsure where to even begin, well, this deep dive is definitely for you.
Right. Our mission today is simple. Clarify what crypto actually is, how it fundamentally works, and, most importantly, how to approach it wisely.
And we're pulling insights from a really rich stack of sources.
We are. We've got a real-world Reddit discussion on beginner resources, which is fascinating. Then there's in-depth analysis from big names like Investopedia and OSL.
Plus practical guides from Changelly and a really comprehensive free course from financial educator Charlie Chang. So a lot to unpack.
Definitely.
Okay, now, before we get into any of that, and this is really, really critical, we have to put a massive disclaimer right here at the top.
Absolutely essential. This deep dive, it's for educational purposes only. This is absolutely not financial advice.
Cannot stress that enough. The crypto market is, well, it's incredibly volatile. Sources like MLC and OSL are crystal clear on this. Investments carry significant risks.
And you can absolutely lose all the money you put in. Seriously, that's a real possibility.
So the information we're sharing today, it's general, right?
Mm-hmm.
It can't possibly take into account your personal financial situation or how much risk you're comfortable with or your specific needs.
Exactly. So please, always seek independent professional financial advice. Talk to someone qualified who understands your circumstances before you make any investment decisions.
Our goal here is just to help you understand the landscape. We're not telling you what to do with your money.
Not at all. Okay, disclaimer done. Let's get into it.
So let's start that journey, this kind of quest for knowledge that many people face. It's relatable. Think about that Reddit user, Jobless Jessica.
Right. They came into crypto with some basic grasp, mining, proof of work, proof of stake, Bitcoin, Ethereum, NFTs, the usual buzzwords.
But they wanted to go deeper, didn't they? Into things like decentralized finance, DeFi, and all these other altcoins.
Yeah, but crucially, without getting totally bogged down in super technical stuff, or even worse, falling for scammers, which is a huge risk.
It really is. So what did the Reddit community suggest? Where should someone like that start?
Well, there were some excellent starting points, actually. For education, Binance Academy kept coming up. Also, MIT classes.
Oh, interesting. Which ones?
Specifically, blockchain and money, taught by Professor Gary Gensler. And what's really cool is one user, Snowy Drop, mentioned enjoying them even though they felt, quote, too dumb for MIT.
Ah, that's brilliant. It shows they're actually pretty accessible then.
Exactly. It really speaks volumes. Other good ones mentioned were Coinbase's beginner info, IBM blockchain classes, and also Sailor Academy.
Okay, and what about video? Lots of people prefer learning that way.
For sure. Popular YouTube channels like Coin Bureau and Benjamin Cowan got recommended quite a bit.
But there were warnings too, right?
Oh, absolutely. A big warning sign was raised about channels like BitBoy.
Mm.
And another user, Northern Tide, gave some really solid advice.
Mm-hmm.
Consult multiple sources. Always.
Good point. Avoid those echo chambers.
You have to, especially early on. Get different perspectives, form your own critical view.
So thinking about that beginner mindset, all this advice,
Right.
what's the core message?
I think a key piece came from Reddit user, Additional Fudge 5068. They basically said, best way to learn is by trial and error and making your own mistakes.
Okay.
Just don't do that with a life-changing amount of money, which, perfectly echoes what Charlie Chang always says.
Which is?
Only invest what you can genuinely afford to lose. Don't chase the hype without understanding the risks. Yes, money can be made, absolutely, but it can vanish just as fast.
Patience and research, not impulse.
That's the name of the game in this market.
Yeah.
Hopefully.
Okay, makes sense. So before anyone even thinks about investing, we need to grasp the bedrock technology here. Blockchain. Investopedia might just call it a decentralized ledger.
Yeah, but that undersells it a bit, I think. The real insight is how it completely changes the game for trust.
How so?
Well, instead of needing a central authority like a bank or government to vouch for things, blockchain lets you trust the network itself.
Okay.
See, data gets stored in these blocks, which are linked together securely using cryptography. It forms a chain, right? Chronological.
And copies of this chain are everywhere.
Distributed across loads of computers, yeah. That creates redundancy. It means no single point of failure, and it makes it incredibly hard to cheat the system.
So someone tries to tamper with one copy.
The network rejects it. because the digital fingerprints, those cryptographic hashes, they wouldn't match up. It makes transactions practically unchangeable or immutable and transparent. It's a fundamental shift.
That is a huge difference from a normal database. But how do new transactions actually get confirmed? That whole proof of work thing we hear about with Bitcoin.
Right. Think of proof of work like a massive competitive puzzle. On Bitcoin's network, these computers called miners race to solve really complex math problems.
And the winner
Gets to add the next block of transactions to the chain. And solving that puzzle also creates that unique cryptographic hash, linking the new block securely to the previous one.
How long does that take for Bitcoin? I heard about an hour.
Yeah, roughly. For full confirmation across about 6 blocks, it takes around that time. But Ethereum, the second biggest crypto, they moved away from that.
Oh, right, to proof of stake.
Exactly. With proof of stake, validators are chosen to create new blocks based on how much crypto they've staked or locked up as collateral. It's way faster and uses much, much less energy.
Okay, so blockchain is the engine.
Yeah.
Let's talk about the fuel, the actual cryptocurrencies. Not just Bitcoin anymore, is it?
Oh, far from it. Bitcoin, BTC, that's the OG. The original, still the largest. Often called digital gold, a store of value.
Because of its fixed supply.
Partly, yeah. Only 21 million Bitcoin will ever exist. Plus, it runs on that big, decentralized proof-of-work network we discussed. It really laid the groundwork.
And then there's Ethereum, ETH, number 2.
Yeah.
What's its main difference?
Ethereum's key thing is that it's programmable. It supports smart contracts.
Which are?
Basically, self-executing contracts with the terms written directly into code. And it also supports decentralized applications, or DApp apps. This programmability is what fuels DeFi and NFTs. Lots of other coins are built on Ethereum.
Got it. What about stablecoins? I hear USDT, USDC. What are those?
Stablecoins are designed to minimize volatility. Usually they're pegged to a stable asset like the US dollar. So 1 USDT aims to be worth 1 USD.
Useful for traders.
Very useful for moving funds between exchanges or DeFi platforms without being exposed to the wild price swings of, say, Bitcoin or Ethereum. They're like a temporary safe haven in the crypto world.
Okay, so if it's not Bitcoin, it's generally called an altcoin.
Pretty much, yeah. Altcoin is just the umbrella term for everything else. Think Solana, Avalanche, Cardano, XRP. Lots of well-known projects fall into this category.
Higher potential gains, I imagine.
Potentially, yes. But, and this is a big but they also come with significantly higher volatility and a much greater risk of losing your money compared to Bitcoin.
Right. And then there are the meme coins. Charlie Chang had a personal story here.
He did, and it's a cautionary one. Meme coins, like Dogecoin or Shiba Inu, they're the highest risk category by far.
Driven by hype.
Largely, yeah. The community and social media trends. Prices can, as he puts it, rocket just from social media, but they can also crash just as fast.
And he lost money.
He said he's had investments go literally to zero because of rug pulls.
Rug pulls.
Yeah, that's when the creators of a project just abandon it, vanish, and often take all the investors' money with them. The coin becomes worthless, like pulling the rug out. Really highlights the extreme danger zone these can be.
Wow. Okay, so we've talked a lot about investing and speculating. But the underlying tech, the blockchain, what's its impact beyond crypto? Where's the real-world transformation happening?
Now that's where it gets really exciting. Because blockchain tech has huge potential to make all sorts of operations more accurate, efficient, secure, cheaper.
Like supply chains. You mentioned IBM's Food Trust.
Exactly. Think about tracking food. Normally, tracing an E. coli outbreak back to its source can take weeks. With blockchain, like IBM's system, you can trace products from farm to table almost instantly.
That could literally save lives.
It really could. Faster identification means faster recalls. It's about transparency and speed.
Makes sense. What about banking and finance? Seems like a natural fit.
Definitely. Blockchain could process transactions in minutes, maybe seconds, 2047.
Yeah.
Compare that to traditional banks, only open business hours, taking days sometimes for transfers or settling stock trades.
So faster, cheaper financial systems.
That's the potential. Lower costs, quicker movement of money, more efficiency overall.
Healthcare too. Secure records.
Yes, providers could securely store medical records on a blockchain. Immutable, private patients control access with their private keys.
And property records. I know that can be a nightmare.
It can. Blockchain could replace that cumbersome, error-prone manual process, create transparent, permanent ownership records. Super useful in places with unstable infrastructure, too.
Voting systems. Could it stop fraud?
The potential's there. Making votes tamper-proof, providing instant, transparent results. West Virginia actually tested it in 2018. could boost turnout too.
That's fascinating. But what about the social impact? You mentioned the unbanked.
This is huge. The World Bank estimates 1.4 billion adults globally don't have bank accounts, mostly in developing countries.
Wow, 1.4 billion.
Yeah. Blockchain, through crypto, can give them access to financial services, a way to store value that's safer than holding physical cash, especially in unstable regions. It bypasses weak financial infrastructure.
So real economic inclusion.
Massive potential for it. Truly transformative.
Okay, so let's say someone listening has absorbed all this, they're intrigued, and they want to actually, dip their toes in. What are the practical steps? How do you start responsibly?
Right. Charlie Chang and Changeley have good advice here. The main way in is usually through a cryptocurrency exchange.
How do you choose one?
Look for key things. Low fees are good, obviously. Strong security is non-negotiable. A user-friendly interface helps, especially for beginners. And make sure it supports your local currency for deposits and withdrawals.
Any reputable names usually mentioned?
Yeah, Coinbase, Binance, Kraken often come up as solid options for beginners.
Okay, picked an exchange. What next? Setting up the account.
Yep. Usually involves giving your email, creating a really strong, unique password, please use Password Manager, and then doing KYC.
Know your customer.
Exactly. You'll likely need to upload a photo of your ID, maybe a selfie. Similar to opening an online bank account these days, it's for regulatory compliance.
Then you fund it. Bank transfer, card.
Usually, yeah. Bank transfer, debit credit card, or sometimes you can deposit crypto you already own elsewhere.
Right. Money's in. Now, safeguarding it. This sounds critical. You mentioned an adage.
Yes, and everyone needs to burn this into their brain.
Yeah.
Not your keys, not your coins. Meaning if you don't personally control the private keys to your crypto, like if it's just sitting on an exchange wallet where the exchange holds the keys, then you don't truly own or control it. The exchange does.
So this brings us to crypto wallets. Hot versus cold. What's the difference?
Think of it like this. A hot wallet is connected to the internet, like a browser extension wallet, or the wallet on the exchange itself. Convenient for frequent trading.
But riskier.
More vulnerable because it's online, yeah. A cold wallet is offline storage, like a physical device, maybe a ledger or Trezor. Much safer for holding larger amounts long-term because it's disconnected from potential online threats.
So beginners might start with a hot wallet on an exchange.
Usually, yeah. But if you accumulate a significant amount, moving it to cold storage is highly recommended. It's the gold standard for security.
Okay, regardless of wallet type, what are the absolute must-do security measures? Non-negotiables.
Okay, number 1, strong, unique passwords for everything. Don't reuse passwords.
Number 2.
Enable two-factor authentication, 2FA, everywhere you can. And crucially, use an authenticator app like Google Authenticator or Authy. Avoid using SMS for 2FA if possible. It's less secure.
Okay, authenticator app, not SMS. Got it. What else?
Third, and this is maybe the most vital, never, ever, under any circumstances, share your seed phrase or recovery phrase.
That's the master key, right?
It's the master key to everything in that wallet. If someone gets it, they can drain all your funds.
Yeah.
Write it down, store it securely offline, never put it online or on your computer.
And watch out for scams, phishing.
Absolutely. Be super vigilant about phishing emails or fake websites trying to steal your login info or seed phrase. Only download wallet software from official sources.
One more thing, sending crypto.
Oh yeah, critical point. Always, always triple check the recipient's address before you hit send. Crypto transactions are irreversible. Send it to the wrong address. It's gone. Forever. No customer support can get it back.
Wow. Triple check the address.
Yeah.
Okay. So given all this volatility, the security risks, what's a sensible investment strategy for a beginner?
Well, Charlie Chang really hammers this home.
Yeah.
Crypto investing should be a long-term game. Patience is key. He strongly advises against day trading for beginners.
Why is that? Too risky?
It's incredibly difficult to consistently time the market, especially with crypto's volatility. Most beginners who try end up losing money.
So what's the alternative? I hear about dollar cost averaging, DCA.
Yes, DCA is a highly recommended strategy. It means investing a fixed amount of money at regular intervals, say $50 every week or $200 every month, regardless of the price.
How does that help?
It smooths out the volatility over time. You buy more coins when the price is low, fewer when it's high. It takes the emotion and guesswork out of trying to buy the absolute bottom, which is almost impossible. You end up with a better average entry price over the long run.
Makes sense. And diversification. Still important.
Crucial. Just like with stocks. Don't put all your eggs in one crypto basket. Spread your funds across different types of coins maybe, and more importantly, diversify across asset classes.
So crypto alongside stocks, maybe property.
Exactly. Crypto should likely only be a part of your overall investment portfolio. Charlie Chang suggests maybe 5–10%, but that percentage really depends on your personal risk tolerance and financial goals.
And the key mindset here is
You are not smarter than the market. Trying to time things perfectly, jumping in and out, it usually leads to losses or making less money than simply holding quality assets for the long term. Time in the market often beats timing the market.
Okay, let's talk more about that volatility. Crypto's notorious for these wild price swings. Why does it happen?
Yeah, MLC, Changely, Investopedia all point this out. Prices can fluctuate at extreme levels. A big reason is that unlike stocks backed by company assets or earnings, crypto prices aren't typically backed by tangible assets or cash flow.
So it's driven by sentiment? Speculation?
Largely, yes. Market sentiment, speculation, news events, network adoption rates, even social media hype can cause massive swings. And while that volatility creates profit opportunities,
Losses can happen just as fast.
exactly, profits and losses can materialize incredibly quickly.
Are there technical risks too, like the networks themselves being attacked?
There are. Investopedia mentions that some blockchains, especially smaller ones with less computing power securing them, can be vulnerable to things like a 51% attack.
Or someone controls most of the network?
Right, and could potentially manipulate transactions like double spending coins. Even big blockchains aren't totally immune to bugs or vulnerabilities in their code, though they are generally very secure. It's a reminder that the tech, while amazing, isn't infallible.
Okay, so given all these unique risks, what are the classic mistakes beginners make? The things to absolutely avoid. OSL and Charlie Chang listed a bunch.
They did. A big one is emotional trading. Buying high because of FOMO fear of missing out, then panic selling low when the price dips. Classic mistake.
What else?
Overleveraging, borrowing money to trade crypto, which magnifies both gains and losses. Ignoring transaction fees, which can eat into profits. Not doing enough research, just buying because someone on TikTok mentioned it.
Trading without a plan.
Huge one, just randomly buying and selling. Also, neglecting security, getting hacked because of weak passwords or falling for phishing scams, chasing pumps, those coins shooting up rapidly, ignoring basic risk management, overtrading, falling for obvious scams, and not even tracking your results to see what's working or not.
Can you paint a picture, a common scenario?
Sure. Someone sees a coin skyrocketing on Twitter, FOMO kicks in hard, they dump a load of money in near the top. Then, inevitably, the hype fades, the price corrects sharply, and they panic sell for a big loss.
Or in a meme coin example.
Right. Invest in a trending coin, looks great on the chart, feels exciting, then boom, it's a rug pull. The team vanishes, the website goes dark, the coin's value evaporates. Charlie Chang's experience shows it happens. Hard lessons.
So the shield against all this, effective risk management. How do you actually do that?
It's absolutely your shield. Changely says risk management is what separates a lucky win from a consistent trading strategy. First step, define your risk per trade.
Like how much you're willing to lose.
Exactly. Many experienced traders won't risk more than, say, 1% or 2% of their total trading capital on any single trade. It keeps losses manageable.
And using tools helps, like stop-loss orders.
Essential tools. A stop loss automatically sells your crypto if the price drops to a predetermined level, capping your loss. It takes the emotion out of cutting losers.
And take profit orders.
The flip side, automatically sells when the price hits your target profit level, locking in gains before a potential reversal. Using both helps you stick to your plan.
And constant research is part of risk management too.
Absolutely fundamental. You need to research any project before investing. What problem does it solve? Who's the team behind it? What's the technology? How does the coin actually work the tokenomics?
Where do you find that info? White papers.
White papers are key. Also, look at their official website. Read community discussions on platforms like Reddit or Discord. Check developer activity on GitHub. You have to dig deeper because, remember,
Thousands are scams.
literally thousands and thousands out there are scams or have zero use in the real world. Due diligence is non-negotiable.
You know, despite all this potential, there's still a lot of public skepticism around crypto, isn't there? Why is that, do you think?
It's definitely true. Investopedia highlights this lingering unease. Partly it's due to those big, high-profile collapses we've seen Mt. Gox years ago, more recently FTX. These events shake confidence.
Yeah, the scams don't help.
Not at all. Plus, the sheer number of scams feeds into that narrative. Investopedia cited a stat that, as of 2024, 44% of Americans still say they'll never buy crypto. That's significant distrust.
And the regulation situation.
That adds another layer of uncertainty. The regulatory landscape is still evolving, and it's often unclear or inconsistent across different countries. That lack of clarity makes institutions and many individuals cautious.
Okay, this has been incredibly insightful, a real deep dive. So to wrap up, the core message seems to be, approaching crypto isn't about luck.
Not at all. It demands learning the foundations, prioritizing security, having a disciplined strategy, and managing risk rigorously.
It's a learning journey, right?
A continuous one. And as Investopedia suggests, it feels like legacy companies adopting this tech is now a matter of when, not if. Charlie Chang also thinks we're still in the early stages, early adoption, with constant innovation happening.
So maybe the final thought for listeners is to consider that broader impact beyond just the price charts. How this tech could reshape supply chains, finance, voting, banking the unbanked.
Exactly. Think bigger picture. And one last time, remember, this deep dive. Purely informational. Absolutely not financial advice. Please do your own research and consult with professionals.
Right. And if you are starting out, remember what Charlie Chang says. Time in the market is often the most important factor. Consistent participation, even starting small, builds that crucial knowledge and experience over time.
Taking action, learning by doing safely is key. And if you want to keep exploring these kinds of deep dives or maybe support the show, you can click the link in our bio.
Thanks for tuning in to The Deep Dive.